Hello, all. I'm Mamta Rawat from the Corporate Communications team at CareEdge, and it's my pleasure to host today's webinar on Sovereign Credit Outlook 2026 in a fragmented world, fiscal discipline, and external buffers to define resilience. Thank you for taking the time to join us. To set the context and host the session further, I would now like to invite Kiran Kavala, Senior Director at CareEdge Global. Kiran has over 20 years of experience across infrastructure, financing, corporate lending, and credit ratings. Over to you, Kiran.
Thank you, Mamta. Hello, everyone. Before we start, let me share an outline to the webinar. There are three segments. The first segment is a presentation by CareEdge Global team. In the second one, we have a discussion with our esteemed panel. And in the third, it's a Q&A session, and we will take questions from the audience. Now, to start with the presentation, let's look at the global trends. We see that there has been a shift in the yields of advanced economies. We see in the chart compared to 2019, currently in 2025 data that we have. This is more than the pandemic level of yields. The yields have been high, especially for the advanced economies. In addition, global government debt is increasing. After a bump during the COVID, once again, the debt is increasing. And on the right side, we see that most of it is contributed by US and China. Further, we see the trade barriers. US tariffs have come down from last year's peak, but still higher than the past. At the same time, we see countries increasingly pursuing discriminatory trade policies on the right chart. Lastly, geopolitical risks are increasing. On the left, we have the geopolitical risk index. On an average, it's been high for the last 3-year period compared to the previous averages. Additionally, there is a shift in the way the strategic rivalry is playing out. It revolves around AI, semiconductors, and critical minerals. So, as we look at this year, fiscal pressures, rising debt, protectionist trade policies, and heightened geopolitical risk will continue to shape the sovereign markets. With these dynamics in mind, I now hand over to Annie, who will take us through the outlook for APAC region.
Thanks, Kiran. In the context of global uncertainties as discussed above, we see that APAC economies are well placed due to their structural strengths that can balance against the cyclical headwinds. These structural strengths are reflected in the form of deeper integration in manufacturing with large share of high-tech exports as seen in the chart 1. We see that strong presence of service sector is depicted in second chart as well, and robust investment potential as seen in the third chart, which shows high share of emerging APAC economies in the overall global investment inflows. APAC economies have certain external buffers as well. On the left chart, we can see nearly half of the economies maintain current account surpluses, and even for the economies in deficit, it remains in manageable levels. These strong trade surpluses have led to sizable forex reserves, as can be seen on the right chart, with comfortable import cover for most of the economies. Now, having talked about the structural strengths, we see that many APAC economies could face certain headwinds amid evolving global risks. While these risks were emanating in 2025 as well, but front loading of exports helped economies perform better, as can be seen from the left chart, with many economies lying above the line, indicating that growth performance was better than previously estimated. However, in the right chart, we see that many economies are expected to see moderation in 2026. This moderation in growth is expected both on account of external and domestic factors. Now, talking about the external challenges, due to domestic weakness, we see that China is pivoting towards external demand. If we look at the left graph, China has already recorded a surplus of 1.2 trillion in 2025, and it is continuing with the upgradation along the value chain. Now, with this, we see that many APAC economies would be exposed to dumping risks, particularly the ones with high import dependencies on China. Now, coming to the internal challenges faced by APAC economies. For few APAC economies, we see that private consumption has not picked up to pre-pandemic levels. Here, in the chart, if we look at the consumer confidence for APAC economies, which states the optimism among the households regarding the state of economy, here we see that the spectrum shows ranges from green to red, indicating high optimism to low optimism respectively. For many APAC economies, consumer confidence has been high before pandemic. However, after pandemic, few economies continue to reflect shades of red. And there are country-specific reasons for it. For example, we see higher cost of living as a stress point for Japan, whereas for China, it is prolonged weakness in the property market. While for few ASEAN countries, it is due to the weakness in the tourism-led recovery, underemployment, and highly leveraged households for few. Now, having talked about the risks, let's look at the policy space available. We know that monetary policy is largely effective in containing inflation, but economies are expected to adhere to fiscal discipline as well. However, broadly, fiscal discipline can be classified into three major categories. Category 1 reflects the economies that face elevated risks, as these economies are likely to see expansion in fiscal deficit in 2026, while debt already remains high, therefore raising concerns about the future debt trajectory. For example, cases like Japan and China. Then there are countries in category 2, where risks are manageable, as fiscal discipline is expected to be adhered in 2026, though adjustments required to manage trade uncertainties will be monitored. And then we have countries in category 3, which have comfortable fiscal position with either low debt or budget surplus, therefore risks are low. So, to summarize, we see that there are risks emanating both on external and internal front, but at the same time, there are sufficient buffers to offset it. That said, there are certain monitorables as well, including Japan's high inflation and slow growth, China's rising debt amid slowing growth. In addition, there are risks on rising social discontent in Bangladesh and Indonesia, and also the geopolitical risks, including the rift between China and Japan. So these things must be monitored. Thanks. And now I hand it over to Girisha for Africa region.
Thanks, Sunny. I now turn to Africa. So Africa's sovereign outlook is increasingly driven by reform momentum. Across our 8-country coverage, we see cautious optimism whereby the fundamentals are improving, but fiscal pressures, external vulnerabilities, and elevated debt continue to constrain the credit profiles in parts of the region. Starting with growth, the chart shows improving prospects over the next 5 years supported by reform momentum and post-pandemic normalization. For example, in Egypt, the 2024 Economic Reform Program focuses on macro stability, exchange rate flexibility, fiscal consolidation, and private sector-led growth. Such reforms do strengthen the investment, export competitiveness, and revenue generation, supporting sovereign credit fundamentals. However, growth remains vulnerable to external shocks and without sustained reform execution is unlikely to materially strengthen the credit profiles on its own. Turning to the public debt, fiscal adjustment across African sovereigns is diverging. Over the next 5 years, as we can see on the chart, debt is expected to decline in Egypt, Mauritius, Nigeria, Morocco, and Ethiopia, reflecting consolidation, stronger revenue, and narrower deficits. However, in FY26, we expect some transitory fiscal pressure in Botswana, Egypt, and Nigeria before consolidation gains traction. High interest costs continue to constrain the fiscal space for several sovereigns, including South Africa, Nigeria, and Egypt. For example, in South Africa, debt has risen over the past decade, but November medium-term budgets show improved fiscal discipline with a second consecutive primary surplus and a smaller deficit. Thus, policy continuity is expected ahead of this month's budget. So from a credit perspective, resilience hinges on stabilizing and gradually reducing debt, while the short-term deficits are expected to benefit from stronger exports or services inflows, while others continue to face structural challenges. South Africa is expected to return to a current account deficit after temporary surpluses, though the deficit remains below the historical averages. So overall, external sustainability remains sensitive to trade performance, import demand, and access to financing, making the exchange rate stability an important consideration for sovereign credit assessments. In terms of the key monitorables, fiscal consolidation and reform credibility remain central to Africa's sovereign outlook. IMF programs in Egypt, Nigeria, Ethiopia, and Kenya continue to anchor fiscal consolidation and policy credibility. By contrast, domestic political and social constraints in South Africa, for example, including the local elections, pose risk in the pace and effectiveness of fiscal execution. Externally, commodity prices, geopolitical developments such as the AGOA renewal, and country-specific factors, including Mauritius Chagos discussions and Egypt's reliance on the Suez Canal revenues, remain key risk drivers. So in summary, Africa's sovereign outlook is gradually improving. Durable credit strength will depend not on growth alone, but on credible reform implementation, fiscal consolidation, and effective management of external vulnerabilities. Thank you. I now hand over to Shobana for Europe.
Thank you, Girisha. Europe is at a critical juncture, balancing fiscal pressures, geopolitical uncertainty, and structural economic challenges, while still benefiting from strong institutional frameworks and funding at the EU level. Thus, our theme for the outlook is walking a tightrope, debt concerns amidst emerging tailwinds. Starting with growth, Europe's economic momentum remains modest and uneven. The chart on the left compares real GDP growth across major European economies for 2025 and 2026. While the headline growth is expected to stabilize in 2026, it remains constrained by weak productivity, aging demographics, and tight financial conditions. That said, there is a clear split within the region. Southern European economies continue to outperform, supported by services-led growth and ongoing support from EU recovery funds, as highlighted by the chart on the right. In contrast, several North and Western European economies face softer growth, reflecting weak manufacturing demand. From a credit standpoint, this uneven growth profile has direct implications for fiscal consolidation capacity across sovereigns. Moving to public debt. This multi-year chart divides sovereigns on the basis of debt to GDP ratio paths benchmarked against the EU average. We clearly see improving debt trajectories in Cyprus, Greece, Spain, and Portugal. This reflects favorable nominal growth and improving primary balances. By contrast, France and the UK remain outliers, with debt levels staying structurally high and well above the EU average. Persistent fiscal deficits and limited consolidation momentum are the key drivers here. Importantly, our focus is not just on the debt levels, but on the direction and credibility of adjustment paths. Moving to fiscal pressures, this chart breaks down the change in the key components of fiscal pressure, namely pension, interest, and defense between 2024 and 2030. We see structural rigidities like pension expenditure to continue to trend upward, along with higher defense spending. What adds to the pressure in the cycle is the rise in the interest expenditure as governments refinance at higher rates. Interestingly, the North and the Western European economies have higher interest and defense expenditures coming up, while Southern European economies will be facing higher pension spending. With elevated geopolitical risk, defense outlays in Europe have risen. The rise, as seen by the chart on the left, is sharpest in the world, further constraining debt sustainability. Despite this, the defense spending as percentage of GDP for sovereigns still remain far away from the 2035 NATO target. Turning to political fragmentation, this chart depicts the seat share of right-wing parties in the parliament between 2019 and 2025. The shift to the right is clear across Europe. This change has driven the policy narrative towards stricter immigration policy and higher resistance to pension reforms. Balancing these challenges are Europe's structural credit strengths, highlighted on the slide. The external position of most of the European economies remains stronger than before. Also, EU share in US imports have increased. However, this remains a key monitorable in face of emerging frictions between these regions. Banking sector's health continues to be strong with improving asset quality and high capital adequacy. Let me conclude Europe's sovereign credit outlook with key monitorables. Growth dynamics reflect interplay between structural headwinds like China's value chain upgrading, innovation lag on one hand, while cyclical support from higher German spending on the other. Secondly, there are debt pressures emerging from interest, aging, high defense spending, and slowing reform momentum by political fragmentation. Finally, there are emerging tailwinds in the form of monetary support from EU funds, progress towards energy independence, and strong banking sector. Thank you. Now I request Mihika to take it further.
Thank you, Shobana. Turning to the Americas, we are seeing that in the US, fiscal pressures remain elevated and institutional concerns are intensifying. Elsewhere in the region, conditions are relatively stable, with only moderate debt increases expected. However, growing US presence in LATAM poses emerging challenges. On this slide, the chart compares 2025 and 26 growth projections for American economies rated by CareEdge Global. Countries below the red dotted line, such as Brazil and Chile, are expected to see slightly higher growth in 26. In contrast, Mexico is expected to see higher growth in 26 than 25. However, it is expected to remain the slowest growing economy in this group due to weak consumption and investment activity. As far as the US is concerned, it is forecast to grow by around 2.4% in 26, up from 2.1% in 25, with higher growth to come from fiscal stimulus, lower policy rates, and AI-driven investment and productivity gains. The chart shows inflation trajectories for different economies, along with their central bank targets marked by the red dotted lines. As we can see, inflation is expected to ease in 26, but for most economies, it will remain above the target. Argentina stands out as it continues to face double-digit inflation, unlike most others. Looking ahead, the US Fed is expected to cut rates by around 50 bips in 26, amidst a cooling labor market, even as inflation stays elevated. Turning to debt, the chart here shows the trajectory of gross general government debt as a percent of GDP from 2025 to 2030. Outside the US, debt dynamics are largely stable. Chile, Mexico, and Peru are likely to see moderate increases. Argentina's debt is projected to fall the most by around 20 percentage points through 2030, while Brazil's rises by 7 points. Canada's debt is expected to remain elevated, though the government's substantial financial assets should help mitigate risk. By contrast, fiscal pressures in the US remain pronounced. The One Big Beautiful Bill Act is likely to sustain large deficits. Gross government debt is projected to rise by 18 percentage points by 2030, reaching 143% of GDP. As the chart on the right shows, the US is expected to see one of the largest increases, second only to China. Many other indebted economies, in contrast, are expected to see smaller increases or even declines in debt levels. Trade and institutional risks are becoming increasingly important. Supreme Court rulings on Trump tariffs, Fed leadership change, and USMCA review could keep policy uncertainty and institutional credibility in focus. These combined uncertainties may weigh on the US dollar in 2026. Politics is also shaping the economic outlook. In LATAM, the 2025 elections signaled a rightward shift, notably in Argentina and Chile, and this trend could continue into 26. Right-leaning governments in the region are likely to pursue more market-oriented reforms and fiscal consolidation through expenditure rationalization. In the US, Democratic gains in the late 2025 state elections suggest they could challenge the Republican majority in the midterms, which may have implications for the government's legislative agenda. Meanwhile, the US is expected to expand its influence across the region, focusing on migration control and tackling drug trafficking. So here is a snapshot of the key monitorables we will be watching. For the US, it is fiscal pressures, policy uncertainty, institutional credibility, and the midterms. For LATAM, expanding US footprint, political shifts to the right, and the strategic importance of its critical minerals will be in focus. The region is also expected to benefit from some tailwinds, such as debt outside the US is projected to be largely stable, and there are also idiosyncratic positives, such as reforms in Argentina. With that, I will now hand it back to Kiran.
Thanks, Mihika. Now, in our next slide, we have a summary of the outlook that we have presented for various regions. You can see all the monitorables and what we've talked about for various regions in this one slide. And that also brings us to the end of the first segment. And in the next one, that is panel discussion, I invite my colleague Nitesh also to join me in moderating the discussion.
Thanks, Kiran.
I'm delighted to introduce our esteemed panel of speakers. To start with, our first panelist is Honorable Hambyraj Narainsingh. He is Minister of Foreign Affairs, Regional Integration, and International Trade in the Government of Mauritius. He holds an LLM from Exeter University and is also a registered PhD student at University of Bordeaux. Prior to the current role, he served as head of the law department at the University of Mauritius and as trade advisor at Mauritius' permanent mission to the WTO in Geneva. Honorable Minister, welcome to the panel discussion.
Thank
Our
you.
next panelist is Luke Marchand. Luke is senior economist and sovereign risk specialist with over 30 years of experience across rating agencies, international banks, and multilateral institutions. He spent 13 years at S&P as associate director in sovereign ratings, and he later held the position of director of country risk analysis at NatWest Group. Luke, welcome to the panel discussion. Our next panelist is Paul Coughlin. He has worked for 26 years for Standard & Poor's, working in all analytical segments of the business across Australia, Hong Kong, and Singapore. He has extensive credit, analytical, and management experience. Paul was the executive managing director and global head of the credit ratings and at S&P, based in New York. Paul, welcome to the discussion.
Thank you.
Before we start the discussion, a quick reminder to all our attendees, please keep sending in your questions. We'll take them during the Q&A session. Now, Nitesh, why don't you start the discussion?
Thanks, and hello, everyone. It was a very insightful presentation by the team, and I'm equally excited to get the perspective from the esteemed panel. And my first question is for Paul. Paul, in our presentation, the team did explain that sustained high interest rates, especially for the advanced economies, and especially when we are talking about age-related and social spending, remains structurally rigid. In this context, how do you see the fiscal trajectories evolving for sovereigns, all the sovereigns, and particularly for the advanced economies?
Thanks, Nitesh. Well, I think for the high-income economies, the outlook isn't terribly encouraging. If you just go back to the slides we've been looking at, there aren't that many high-income economies where there is a really a positive outlook for debt. Those that do are often countries like Greece, who are coming off a really bad sort of recent history and are struggling to get back to a better equilibrium. So I think that's all out there. There remains the mystery of Japan and its level of debts, but nevertheless, I think for a number of these countries, debt levels remain sustainable. Few countries, for example, are at the same level as India in terms of percentage of budget going to debt service. So I'm not I'm not pessimistic about defaults in the high-income countries. I think some of the European countries, as members of the Eurozone, obviously have structural limitations, but we've seen the Eurozone cope with that in the past under severe stress. So in terms of risk of default, I think the outlook, is reasonable. It's manageable. Obviously, things in the US are actually turning out better than we would have imagined a year ago. The US is certainly still, hampered by the extreme partisanship between the two sides of politics, which finds expression by the periodic government shutdowns. But then again, we've been seeing those for the past 40, 50 years. I think for those not used to it, it does look very frightening, but to date, it hasn't caused defaults or anything approaching it, although it has probably got close a decade or two back. But as I say, overall, things in the US are looking better than we would have thought. I thought the things that I'd be keeping a lookout in terms of disruptions are the political issues, China and Taiwan, the US and Iran, and some of the possible outcomes there are probably the positive ones are the ones worth keeping an eye on. For example, if peace breaks out in between Russia and the Ukraine, and there isn't a war between the US and Iran, and there are resolutions of those conflicts or potential conflicts, it actually will put a lot more oil back on the international energy markets. Likewise, if Venezuela manages to resuscitate its oil industry, between the three of them, that could put really a lot of oil back into the markets, which would imply probably a significant fall in oil revenues. And that would imply real risk of default for the oil-dependent economy. So that's something worth keeping an eye on, I think, over the next couple of years. And likewise, I think while we were talking about China's trade surpluses as being a strength, it also, I think, there's the risk of quite the reverse, that America is already quite tired of China's trade surpluses and the undervaluation of the Chinese currency. If China just keeps on racking up larger and larger current account surpluses, and perhaps this time is doing it at the expense of the Europeans, I think there's already the pressure in Europe for more trade sanctions against China, particularly as Chinese automobiles impact the European market. So I think just looking to see how China fares on the external front is worth keeping an eye on, and are their trade surpluses really the genesis of increasing trade restrictions from the major trade blocs around the world.
Thank you, Paul. This is very helpful, and it just walks us through the entire globe, region by region. And in this context, let me look into the discussion. So, look, we did discuss about the high yield and the high social spending across the world, and this issue is more pronounced in Europe. And if we add the defense spending being on a higher side, which our team did highlight in the presentation, and Paul has added one more dimension, is the energy dependence on the rest of the region. So in these situation, what's your view for the Europe as a region on the sovereign credit outlook?
Okay, thank you for the question. Yes, first of all, I would concur with Paul that in advanced economies, there's been reminded that in a case of a crisis, they would sustain significant shocks, further shocks. First of all, the energy shocks. In Europe, it's only a very small part of imports, the energy. It's not anymore a very big part of your balance of payments, despite the fact that the increase in oil prices has increased inflation in the last few years. Now it's on the way down. And as Paul said, there's actually risk to the downside on oil probably in the next few years if there's a lot of more supply. So on oil shock on Europe, at least this is some kind of future shock that is not the most important one. Second, interest rate. Interest rate are decreasing because inflation is decreasing, but they are on the way up in some countries because their access to markets is a bit less. And here you have France, you have the UK a bit. Germany is not showing much because anyway, even with their increase of fiscal expenditure in the next few years, the market loves them and it will continue to love them. The crash expected in the Eurozone or in the EU is not what I see. I see further rating downgrades or negative outlook for France if they continue not to address their fiscal constraint on the social side and the pension side. But they just passed the budget finally 2 days ago, and also they will have benefited as other Eurozone countries, the decrease in inflation. The GDP is actually picking up a bit in the last few months, but that's not only for France. And the growth will over about 1% this year. And it's a bit the same in all over the EU. One bright spot in the EU is Spain. Spain has done a lot of reforms and they have higher potential growth. This will permit them to continue the fiscal consolidation, despite the fact that recently they've indexed, I think, their pension. That is a bright spot for Europe. And there's another bright spot, but that's on a very low basis, is Greece, because they had a huge stock of debt, and the management of it and some reforms decreased the debt burden in Greece. But this is the cleaning up of after a catastrophic situation, and it's just continuing and accelerating. That's a fact. But don't forget that they had a very big problem. And in terms of interest paid on debt, you have to be careful. Most of these countries have reshuffled their debt. 2/3 to 4/5 of all these countries, they have fixed interests and long-term debt. And most of it is in their own currency, the euro. Or in the case of the UK, it's the guild. So it's really you issue in your own debt. It's very important. So this is decreasing the risk, and it's not comparable in that sense to the debt burden in percentage of GDP in LATAM, for example. It's not one-to-one, the comparison. Okay. Yeah, that's all I wanted to say on Europe.
Thanks, Luke. And this is really helpful to know that there are risk or from a sovereign rating point of view, but that there are enough cushions or buffers available for various countries. And may I request honorable ministers to share his perspective. And I'll just put this little in context that in the African region, we have seen, and even that's true for even APAC region, but focusing on Africa for time being, we have seen interest rate has relatively remained high for the African region, and now we see the social spending and the need for capital expenditure is also increasing. So, in this context, when you have different priorities or conflicting priorities, how do you see the African region is looking at the high interest rate environment in terms of multiple priorities?
Yeah, so for Africa, you really have different kind of cases. You have the mineral and raw material countries. They are dependent on the prices of these raw materials and the production they have in the country. There's been a lot of problem. And you add that to the enormous debt that they have accumulated during the COVID time.
Got it. Look,
And
I was asking
just
this
after that,
question to
the interest rate. So the
yeah,
conjunction of all of that led to a number of default.
got it.
But some have turned the corner. Some are still, in the triple C category or B minus. And this category is always to watch because these are very like five countries that are always really in trouble. And there's new country, unfortunately, with some vulnerability. I saw Botswana was also dependent on few minerals, but they have a good management, but their debt sustainability has a problem now. Even the IMF is forecasting an increasing in debt, which is exceptional for the IMF.
Sorry to interrupt you, Look, uh, and this what context you've given to Africa, and let me go back to Honorable Minister. Sir, what I was asking is how do you see the fiscal situation from an African country's point of view? And I will also add what Luke was talking about, the dependence on mineral. So if you could give us perspective, because you are based out of Mauritius, and Mauritius is a international financial center, very important economy in the Africa. Overall economic outlook for various countries, and particularly if you could share some light on what's the reform agenda we are seeing in the Mauritius.
Okay, thank you for this very pertinent question. As you know, at the level of Africa, Mauritius forms part of a number of important treaties like the SADC Treaty and the COMESA. And now we are trying to finalize the AFCFTA. And we have been advocating for a number of years now that there is a very imperative need to shift from just selling raw materials, because then we will tend to be very vulnerable to the external shocks. So we are trying to sensitize all the African countries to transform the raw materials and to be more market oriented, and this is like the new strategy. And I'm sure that with the test of time, we are going to succeed. It is important, if you look at the sort of landscape, international landscape, before trade was basically more, we were governed by universal rules, as you are fully aware. But now more and more, it is true that 70% of the trade is being overseen by the World Trade Organization. But at the same time, in recent years, what we've seen, there is a shift from that purely multilateral approach to a more sort of, I would call, a sort of multipolar or multinodal approach. And Africa, we have taken good note of this shift. And this is why, in a way, we are, of course, having the traditional sort of cooperation, collaboration with Europe and with US and also with China. But at the same time, we want to have more intra-African regional trade. And also we are having further more collaboration with India also. And as you know, Mauritius is a gateway to Africa. And we are playing this role in full collaboration with a number of emerging economies. And especially with India, we have more deeper collaboration. And I'm sure that with the test of time, what we have wanted to do for many, many years will become a reality very soon.
Thank you, Honorable Minister. I think it's helpful to know the measures that the African economies and Mauritius in particular, the kind of measures that are being taken to cushion against the shifts in the trade. With that, I would like to turn to Paul. My next question is to Paul and to the APAC region, and taking a cue of what Honorable Ministers mentioned about trade. APAC economies, relatively, the debt levels are lower. there is a fiscal discipline but at the same time, they might have to respond with a fiscal stimulus to manage the trade uncertainties. How do you think the APAC economies are placed to manage this additional fiscal support with the existing, measures that they need to take?
Thanks, Kiran. Well, there's no easy answer to that because the situation varies from country to country. Just picking up on the minister's comment, you have seen Indonesia do exactly what the minister has been suggesting, and they have started processing their nickel resources within country. But I think it does show the limitations and the challenges of that approach because it assumes you've got a bit of a strong stranglehold on the mineral in question, and the Indonesians did have a fair and still have a fair slice of the world's nickel resources, and they were prepared to allow foreign investment. They were prepared to allow the development of cheap coal-fired power stations, and they took a very relaxed attitude to pollution, workers' rights, all that sort of stuff. So, but having done that, they've got a bit of a stranglehold on the world's nickel market. So that kind of desire to add value is there, and sometimes it is successful, although, again, it does require a number of factors to coincide. Otherwise, as I look around Asia Pacific, I mean, as I mentioned, enormous differences there. I think about Vietnam, which was probably the country which was and is the country most exposed to threats of trade limitations from the United States. So it had been pursuing that classic export strategy to drive growth and increasing income, and had really developed very strongly as an alternative manufacturing base to China. I think it was surprised when the US started its sort of trade war. It was on everyone, not just on China. So I think it was hoping to actually benefit from a trade war with China, but it didn't turn out that way. Now, happily, they've negotiated an outcome which is not too damaging. And so I think the prospects for Vietnam remain quite good. But again, it's actually got quite a narrow economic base. Growth is highly dependent on property development and property prices. So you go to Vietnam, you're probably looking at two things: the export industries and property prices. Whereas in China, which is the big one, I think the chances of the central government defaulting on its debt are infinitesimally low, as most of the debt is actually held at lower levels of government. The safety of that debt really does vary enormously with the regional or local government in question, and the view of the central government at the time, which is frankly for outsiders rather hard to decipher. So I think China's policy has been to make up for the slowdown in the property industry by supercharging exports of one kind or another. And as I mentioned in my opening remarks, I think that has the seeds of further conflict. And when you get back to Luke, I'd be interested in his view from Europe, how the Chinese sort of export push is being viewed there. Otherwise, Japan is an interesting case of huge debt loads and just consistent fiscal stimulus over the years. The economy has been picking up in the last few years, and the risk of default remains very, very slow, as the large slice of government debt is actually owned by the central bank. So it's if you were to consolidate the entire public sector, that a large slice of that debt would disappear. So it does mean that for 20 or 30 years, essentially, the Japanese government has been printing money, and there hasn't been apparently any ill effect of that over that period of time. And it's now only that you're seeing some form of what everyone else would regard as normal interest rate policy, and and an expectation of positive interest rates. But again, they're not that high, and they don't present a great deal of trouble for the government there. I could go on for some time. I guess I just hit the highlights of some interesting development in Indonesia. As I say, I think the country with the most at stake in these trade talks is probably Vietnam, and the big one obviously is China, and its affairs remain as mysterious as ever. But it just struck me, ever since I got into the credit rating business 30 or 40 years ago, people have been predicting disaster for China, and it never quite happens. And so I remain conscious of that history.
Yeah. Thanks, Paul. That's a wide-ranging response that you gave us. I was going to ask you about China. You covered that. And Japan also, very pertinent. We can just look at the debt levels and worry, but at the same time, the nuance that you added is helpful. And as you rightly said, very diverse set of economies in the region, so with a different set of issues. But just I want to go back to Honorable Minister. He did start the topic about the whole economy agreements to bilateral agreements. We increasingly are looking at bilateral agreements. Most recently in India, we have a India-EU agreement, then the deal with US. Minister, I would like to take your perspective on the future of the trade agreements. Will we see more and more of these bilateral, or it's going to be a balance between multi and bilateral? So what do you see, overall and specifically for Africa?
So what we are seeing nowadays, we are witnessing a sort of unprecedented situation. For example, if I take for Africa itself, you've seen how we had to struggle to preserve, for example, the AGUA with the US. And fortunately, it has been sort of renewed for 1 year. So whatever we are witnessing, I think this has in a way, it's a wrong for a good thing. I think Africa is waking up in a way, taking cognizance of what is happening. And this is why you will see, for instance, with US, some African countries, they want to pursue the sort of agreement at the multilateral level, but at the same time, pursuing the bilateral level negotiation. So one would not preclude the other one. So I think this is important. Now, as I mentioned before, besides preserving our traditional sort of agreements with major economies like the EU and also with China and US and other emerging economies like Brazil and also India, we are trying to push for our own, consolidate all these agreements that we have within Africa. And we are encouraging more and more African countries to have more trade within themselves. But at the same time, the mode of settlement in order to avoid sort of issues with what I would call foreign exchange, the FX stability. We're also taking precautions, for example, to have settlement. For example, we have a number of mechanisms within African Development Bank, and also within the African Development Bank, we have other sort of sub-mechanisms like the PAPs and other settlement arrangements with a number of other countries. So I think what is important, at least Africa is fully aware of what is happening, and I think concrete measures are being taken. And in the case of Mauritius, as you know, is a small dot in the Indian Ocean, but we've got some expertise, and also we've got some compared to other African countries. We are a respected financial center, and I think in relative terms, we are doing great things. And we're going to continue on that line. And I'm sure that with our new sort of governmental program and with a number of reforms that we are trying to drive in Mauritius, difficult reforms at times, on the verge at times of creating some discontent within the population. I agree that other African countries will have to make these important systemic reforms. But I would believe that in light of our recent experience, for example, we've been trying to reform the basic retirement pension, and we had a sort of UN pride with the public. And obviously, as a very democratic government, we have to listen to people. We have to take into consideration their criticisms, and at times they are very important criticisms. And after, even if you've taken some measures for reforms, I think you have to listen to people. You have to strike a sort of balance between your structural reforms and what people are saying, and then you can adjust. You cannot go blindly into reforms. So I think it's important to strike the right balance, and this is what Mauritius is doing. And I believe that at least 10 other African countries are trying to bring all these reforms, and in a very balanced manner. And I would tend to think that for at least for a number of these African countries, we are going in the right direction. And also, it is not good to put all the eggs in the same basket. Very important to diversify and to have not only friendly relationship, to have deep economic collaboration among different poles, and not to focus on only one market.
Thank you, Honorable Minister, for that. Just giving us a peek into the mind of the government. On reforms, we would like to speak a little further, maybe in some time. But at the same time, we take your inputs on more regional collaboration, and even in settlements and transfers, etc. I think that's what we see in the ASEAN region also. They call it inward looking. If I can get Paul's perspective on this again for Asia Pacific specifically, to close out the discussion on trade. Asia Pacific has service exports. At the same time, maybe despite the tariffs, the competitiveness of Asian exports, maybe they're still pretty good compared to various other regions. So, do you think the APAC economies need to be too worried about this, or they're still competitive despite the tariffs?
Well, they need to be worried about it. I mean, some places, let's say, like Vietnam, are just extraordinarily dependent on exports to the US. So others haven't aren't so exposed. But yeah, so they do need to be worried about it. I think the countries that have significant service exports are in a better position: India, Philippines. And it seems President Trump just hasn't turned his mind to service exports. So, and in some ways, the increasing restrictions on the export of skilled Indian and Philippine labor into the US is actually keeping those folks in their home countries, and actually probably going to in due course, enhance service exports rather than actually have the people transplanted into the US. Which is probably ironic, really. So, but I think those who are in the service side, which is more India and the Philippines, I think they're relatively better off than those who have the sort of reliant on the nuts and bolts exports to the US. Although, with that being said, I do see that tensions with China are going to continue on long term. And I'd still think that, just as we were before, I think that does provide opportunities for enhanced manufacturing in India and other places in Asia. So whilst at the moment I think the trade disputes seem to be rather haphazard in their management, I think simply because of the size of Chinese current account surpluses, I think both the US, and I would like to hear from Luke on Europe, will come back to revisit trade openness. And I think China is making a real problem for itself in continuing to pursue what amount to mercantilist policies, which are just simply not viable in the long term.
Thanks, Paul. So the world economy will be hovering around trade, Trump, and tariff. So, now shifting to growth, economic growth, because the growth in debt can be manageable if the growth is high. And let me get this perspective from Lok and Honorable Minister, one from European perspective and one from African region perspective. And let me request Honorable Minister to share his perspective on the growth in the region. So Africa has been a high growth region, but it has been volatile and it has been not consistent across countries. So what do you think the region should do to maintain the growth, to cover up from that point of view? And what all additionally needs to be done to attract more investment from other part of the world?
Well, you will see that I will take the example of Mauritius. You will see that we are trying to, we have put in place a number of policies to attract FDI. At one time, let's say 15 years back, we have been quite successful, and we have to confess that in recent years, there has been a sort of dwindling down of FDI. So we are trying, this is why we are trying to re-engineer our policies. And so we have to give more facilities for the ease of doing business. So even if Mauritius is considered to be, in terms of rating of ease of doing business, as the number one or among the best in Africa, we are not resting on our laurels. We are trying to improve. This is one thing we are doing. But at the same time, you will see that we are giving a lot of incentives. And what is important also, we are trying to diversify, because before we had a lot of investment basically from Europe. And since a sort of slowdown in terms of investment from Europe, we are trying to attract a lot of the investment from India. And I myself recently have been on a number of missions in South India, in Coimbatore, in Hyderabad, in so many different parts of India. And also, I will give you other concrete examples. We are trying to organize a number of important road shows. For example, very soon, in April, we are going to have a road show for business people, the EFCFTA, which will be organizing an important road show. But even if you are trying to diversify, trying to look at the attract investment from India, from Africa, even from China, we are not neglecting the traditional ties in terms of business with US. And it is good to know that, for example, we are going to have in July also an important US-Africa trade forum. We're going to have another important business trade forum regrouping Southern Indians in the months of August. So we're also participating in a number of other fora in Africa and outside Africa. And what I've noticed also, it's not only Mauritius doing that, and many other African countries outside, for example, Rwanda and Ghana, and even Kenya, they're trying to emulate and follow what we have been doing in Mauritius. And I think I cannot generalize, but I think for many African countries, they are taking concrete steps to attract FDI. And also what is important, I think, to diversify the multiple sources, not to focus on only one country or one segment of the market.
Good, sir. I think very, very comprehensive answer. And most importantly, the way you said that Mauritius, while the best, but that should not be the start, that should not be the end point. You should keep improving on that also. So, look, may I request your views, Europe, because growth, yes, each region have a different problem statement, but Europe, the growth, slower growth, or you did mention 1% something, has been
Yeah.
there even from the pre-COVID. So, what's your view? What all can be done to improve it?
Yeah, in Europe, I mean, 60 to 70% of growth is consumption investment. So consumption essentially. So it depends on the purchasing power of the modest people. Their wages has not increased a lot in part of Europe. So the consumption is a bit in disarray at the moment, and they wait for more push in this area, maybe some change in tax system, but also to have on the supply side more diversification in each of the economy. So this is a point that is the most difficult and most striking. So the long-term growth in Europe, in all European countries, went from 2.5% about 30 years ago to about 1%. You had bright spot, the UK, Ireland, but now Spain. So more than 2%, and that's good for debt sustainability. But for all the other ones, they have problem of debt sustainability because of the low growth and relatively higher interest rate. But again, these interest rates were not very high because of the structure of the debt and because of the access to market anyway. So the real problem is not interest rate. Your chart at the beginning, interest rate has spiked. It's not a problem. It's the low growth the problem. So change your chart to low growth. That's very important, at least for Europe.
Got it.
And then for Africa, that's the reverse. How to make this growth that is actually quite high because of capital and labor that is, the production function in the long term in Africa is very clear. It's like in India. It's very high growth. Capital and labor looking forward is very high. Okay, so growth perspective is quite high. You need also condition. India has done a lot of condition for that, and you have in Africa the lack of conditions, business governance problem, and also long-term avenues of growth. So these long-term avenues, when you don't have enough capital, you have to import capital. You have two ways: the portfolio or the direct investment. On these two fronts, there's a problem in Africa. And Mauritius is one of the biggest financial center that is trying to help the African Union and other institutions to create financial institution that will permit to attract foreign direct investment, portfolio investment in more sustainable way. So change the rating system, having a more local rating agency, etc., for the portfolio side. And on the FDI side, as the minister said, diversify FDI portfolio, not only in mining, but also in the other sectors. Take Morocco. It's the role model. I love Moroccans. I've been an analyst for Morocco for many years. But why I love Morocco on that? They have been advocating for this long-term FDI in different high value-added and long-term relationship in industry in the north of the country. Now it's It's in different big cities, then the infrastructure, the train, the solar panel. That's what Africa needs, long-term investment in this area. And there's plenty of opportunity. But it's blocked at the moment because there's bad image of African countries. They don't believe that they can invest because lack of governance. In Morocco, people think, more than 2,000 years or 3,000 years, the same system. It's a bit archaic, but it's stable. It's stable, and people know where they are going, and that's the big thing. And so for the long-term investment is quite important. And also behind the ministers are really, minister. When you meet the minister of tourism in Morocco, he was like forward-looking like 10, 20 years ago, and still they have very active policies and how to attract this investment in the long term. So it's my answer. It's different answer in Europe, different challenges. But in Africa, certainly sustainability of FDI, governance, better governance and reforms that will go together. And Mauritius is helping us. I'm also an expert for UNDP on that, to attract more investment to Africa in general.
Thanks, Luke. And you also did mention about different way of looking at things, and that's what we try to do at CareEdge Global, bringing in a fresh perspective for sovereign ratings. But all relevant points that you mentioned. But it's been a very engaging discussion. But in the interest of time, I'll just look at what the audience have for us. There were quite a few questions, but I'll just pick one on a very relevant topic from Cedric Wong. It says, we now have a pick for the next US Fed chair. Given the many events happening there and potentially the central bank independence being undermined, coupled with the debt on an upward trajectory, is there a risk of a US credit rating downgrade, and by what magnitude? Maybe I'll request Paul if you can respond to this audience question. Is there a risk to US rating given all that's happening on the institutions, debt, etc.?
Well, it's a very good question, and obviously it is a question on many people's lips. I would, again, as I mentioned before, things have not turned out as badly, or indeed at all badly, as we would have thought a year ago. And so we would have expected inflation to have spiked by now. It hasn't. We would have expected all sorts of things that so far haven't arisen. And so I think you need to keep your stay calm is my a general advice. And in terms of the proposal for Kevin Walsh to be the next Fed chair, keep in mind that he's an experienced hand. He's not some crazy from the nether reaches of of Trump's fan base. He's a respected, experienced person, whilst independent central banks have generally been a positive thing. At the end of the day, central banks need to work in conjunction with fiscal policy. There's no point having an ultra-loose fiscal policy and at the same time a restrictive policy going in different directions. You do want some coordination, and in a number of countries you do see that institutional coordination. Certainly in Australia, where I am at the moment, the Secretary of the Treasury, the key bureaucrat dealing with fiscal policy, is on the Monetary Policy Board, has been there since the Reserve Bank did become independent some decades ago. And in other countries, you do have mechanisms for that coordination. So the US is a bit unusual in the degree of independence. And I would just say that, the guy that looks like being appointed, is a monetary policy, experienced in that area. But he won't be making monetary policy by himself. There's a whole institution there that'll, the majority of people who have been doing what they've been doing for the past several years is going to be there, even if we have a new Fed chair. So I do think, stay calm. The long-term, challenge in the US is, though, the the level of debt. And indeed, that, as we saw from one of the slides in our initial presentation, that's going up. It is true that growth is probably a bit more healthy than we would have expected 12 months ago, and that's good. But the rate of US growth, even if it meets its potential, is still going to be outpaced by the speed of the budget deficit and the accumulation of debt. And so you would have to think that the likelihood of an upgrade for the US is pretty distant. And if you were tossing a coin, the other, probably as debt continues to accumulate and become more of a pressure on their budget, then I think that's when you and probably those institutional battles I spoke about before, if they become even more destructive than they have been in the past, then that's more likely to actually enhance risk of default than this gradual growth of the debt service burden. So,
Thanks,
I
Paul.
guess it's a long way of saying I'm not expecting any fiscal crisis, but the direction of credit would seem to be pretty clear.
Yeah. Thanks, Paul. It's not all bad news on institutions, but fiscal to watch out for. Maybe a quick, perspective from Nitesh. What's the CareEdge Global perspective?
So
Yeah.
thanks. Paul has already covered from a direction perspective, and that's getting reflected in our rating on US. So our rating is AA plus, though on an outlook side we have negative. So which means there is a 1/3 chance that the rating might slip downward. And for us also the key watchouts are the high debt level as well as the institution. So these two are the key monitorable for us as well.
Thanks, Nitesh, for that. There's one question on dollar. Look, if you can answer this. The question is, what is the expected impact on dollar debasement on global yields and thereby debt sustainability? So impact of dollar on debt sustainability.
Yeah, the dollar is weakening at the moment. So it's actually, by the theory, good for external debt of emerging markets because they have debt in dollars. So the weight of the dollar compared to their own currency is a bit lower. Now, that's the theory. Um, and first of all, it might not last. All this movement around the dollar, the gold, all of this at the moment, it's really not stabilized. So we don't know exactly where it's going to end up in the end of the year. Okay. So that's one thing. Second, how it is affecting the different countries. It is certainly not improving the competitiveness of European countries because the exchange rate with the euro, it's in favor of the euro. It's decreasing our competitiveness in Europe. This weak consumption I was talking about, it means that the net export is essential for Europe for surviving. So our competitiveness. And competitiveness is the labor cost, and it's also the prices, the exchange rate. Okay, and so labor cost is quite high. You can't play too much with this unless you're in Romania or the last arrival in the EU. And on the other side, the exchange rate you can play on it, but you are also victim of the monetary policy in the US. And at the moment, it's not very good. So we are not very competitive on that. So the net export is not going to be very high, neither in Europe because of that. That's my answer. On the other countries, yes, it's a small respite of the weight of external debt of some countries. But in general, it's not the problem. The problem is the debt sustainability in each of these countries. And the exchange rate part in the debt sustainability equation is not the most important. Again, it's the difference between the rate of growth and interest payments. And as you saw in Saul's chart, at least in Africa, you had a lot of interest payment coming up. So you really have to fuel the machine of growth to make the debt sustainable and to decrease your primary deficit. So you really have to make your budget more in line with what is accepted in the fiscal consolidation.
Thanks, Luke. Thanks, Luke, for that. And yeah, we have two questions for the Africa region. And I request Honorable Minister, I mean, we extended the session a bit because of the number of questions that we are getting in. But if we can get your response on this. The first question is, considering Africa's rising debt levels, fiscal pressures, and the structural reforms, what do you think is the likely economic outlook for the continent for the next 10 years?
So, in spite of all the systemic issues Africa is facing, I'm sure with the structural reforms, and as I mentioned, I will lay a lot of emphasis on the consolidation of the trade agreements. I'm pretty sure that we are going to live up to the challenges of people. And what I've noticed also in many African countries, side by side with structural reforms, I think governance is a very also important issue. And many African countries, I think one of the speakers mentioned about governance, and we in Mauritius, and also not only Mauritius, but also I cannot say all the 54 African countries, but a substantial number of African countries are taking bold steps in order to curb corruption and also to improve governance. So I think if we continue in terms of improving governance, and as I mentioned before, improving intra-regional trade, and why you see the danger is why we want to make inter-regional trade a reality. We should not also neglect our traditional partners. So I think it is very important. You want to diversify, you want to venture to new markets, you want to make friends with other people, but at the same time, I think it is important to maintain what you got, and so it is quite a difficult and daunting task. But I think countries, some of the African countries which will succeed, is how you will make that shift from traditional alliance, traditional sort of relationship, and how you want to diversify. I think this is important. And also, we are in Africa, and I think one of the speakers mentioned about Morocco, but not only Morocco, many African economies are trying to develop new poles of development. For example, when I'm here, I'm referring, for example, to renewable energy. I'm referring to AI. I'm referring to blue economy. A few African countries, including Mauritius, which is trying to take a lead in really promoting blue economy and AI. So if we can, so what is also important, I think, for African countries, not only to develop blueprints and strategies on paper, but to try to walk the talk and make things happen and make things concrete and I think this is very important, and this is what Mauritius is trying to do. But not only Mauritius, but what I've been traveling across Africa for the past year. I think a substantial number of African countries are alive to the need to walk the talk and promote governance along with new poles of development.
Thank you, Honorable Minister. That aligns with our tagline for Africa. It's the potential, the growth potential that's there in the region that we are looking for. Quite a few questions. Our submission to the audience is that we'll try to get back to you with our responses where we do have your name. We'll do that. Otherwise, we would like to end the webinar here. A heartfelt thanks to all our distinguished speakers. It was truly an honor to have you with us. And to all our participants, thank you for joining and engaging with us. It's been an overwhelming response, and we look forward to your feedback. If you have any further queries, suggestions, or comments, please feel free to respond to our feedback mail that you will be receiving shortly. And with that, we come to the end of the webinar. Thank you so much, and goodbye for now.
Thank you.
Thank you.
Thank you.
Thank you, Minister. Can we offer you some coffee or tea?
Yeah, coffee. Yeah, I think.
Tea?